Hello, Mark Lloyd, Leader One Home Loans. This will be a 5-part series on debt-to-income ratios. How to calculate debt-to-income ratio for a mortgage or loan. Just like physical health, financial health turns on a slew of different factors, some more important than others. It's tough for non-experts to keep track of them all. While you don't need an encyclopedic knowledge of all the components of a good credit score or the considerations involved in loan underwriting decisions, it doesn't hurt to know what pleases lenders and what turns them away. Besides your credit score itself, the one metric worthy of further investigation is your debt-to-income ratio. It's hard to overstate debt-to-income's centrality to underwriting process. If your ratio is too high, you'll find it very difficult to secure personal loans and other types of credit at reasonable rates. That can have serious ramifications for your lifestyle and personal financial health, some of which we'll discuss in greater detail. Here's what you need to know about the debt-to-income ratio, how it's calculated, why it matters, its limitation as an indicator of financial health, and what you can do to improve your personal or household ratio. What is the debt-to-income ratio? It's a pretty simple concept. Your debt-to-income ratio compares what you owe against what you earn. It's, in mathematical terms, it's the quotient of your monthly obligations divided by your monthly gross income. R equals D divided by I, whereas the D is your debt, I is your total income, and R is your debt-to-income ratio. How to calculate your debt-to-income ratio? You can calculate your debt-to-income ratio in 4 easy steps. 1, add up your debts. First, add all your debts. Obligations commonly used to calculate your debt-to-income ratio include mortgage, including escrow, taxes, insurance, or rent payments, car payments, student loan payments, personal and other loan payments on any loans you've co-signed, an important item for parents with debt-burdened adult children, alimony, child support, home equity loan payments, and minimum credit card payments, even if you charge more. This is not a complete list of debts that can factor into your debt-to-income ratio. If you're unsure about what your lender looks for, ask for me directly. 2, exclude expenses not considered debts. Your debt-to-income ratio numerator only includes expenses deemed debts. It's not a total accounting of your monthly liabilities. Non-factored expenses commonly include utility payments such as water and electricity, most types of insurance, including auto and health insurance, transportation expenses except for car loans, cell phone bills and other telecommunication expenses, groceries and food, most taxes excluding your escrowed property taxes, and discretionary expenses such as entertainment. 3, add up your gross income, add up all your sources of income before taxes. If you have a full-time W-2 job, this is as easy as looking at your most recent paycheck. If you have multiple part-time jobs, work as independent contractor for multiple clients, or own a small business, it's probably easiest to refer to your prior year's tax return, assuming your income has not changed significantly. Or manually add up receipts using your most recent bank account statements. 4, divide step 1 by step 3. Divide your monthly debts as defined in step 1 by your gross income as defined in step 3. That is your current debt-to-income ratio. Here's a simple example. Say your total aggregate monthly debt, excluding non-debt expenses, is $1,500. Your monthly gross income before taxes and household expenses is $4,500. Your debt-to-income ratio is $1,500 divided by $4,500, or 33.3%. Tomorrow we'll discuss why debt-to-income matters. You can reach me at www.talkwithmarkloyd.com. Call or text 207-478-2065. Thank you.